Hi everyone, here's what's driving investors absolutely crazy right now. Everyone's asking the same question. Should I buy SCHD, VYM, or JEPI? And here's the thing, 99% of financial advisors are giving you the wrong advice because they're not looking at what's actually happening in 2025. I just spent 6 hours analyzing the real data behind SCHD's recent underperformance. And what I discovered will shock you. While SCHD has been called America's favorite dividend ETF, it's actually been beaten by its competitors in some surprising ways. But here's the twist. This might be the best buying opportunity in years. I'm about to reveal the truth about SCHD versus VYM versus JEPI, including which one Wall Street analysts are secretly loading up on, and why the loser of 2025 could become the winner of 2026 to 2030. Problem agitation. Problem number one, you're choosing based on outdated information. Most investors are still using 2022 to 2023 performance data to make 2025 decisions. But here's what's actually happening. SCHD is up 1.34% year to date, while JEPI gained 2.90%. Meanwhile, VYM has been trading at $136.28 with steady performance. Solutions? Current reality check. SCHD's 3.82% yield versus VYM's approximately 2.8% versus JEPI's 8.32%. Performance truth. JEPI leads year-to-date 2.90% versus SCHD 1.34% versus VYM steady. Risk assessment. SCHD has minus 33.37% max drawdown versus JEPI's only minus 13.71%. Problem number two. You don't understand the underperformance trap. Here's what financial media won't tell you. SCHD's recent struggles aren't random. After 9 straight years in the top third of its category, it fell to the bottom 11% in 2023 and bottom 25% in 2024. In 2025, 90% of funds in this category have outperformed it. Solutions? Sector exposure reality. SCHD is overweight in energy and healthcare, the market's worst performers. Tech underweight problem. Only 8% tech allocation while mega-cap tech dominated returns. Quality premium timing. SCHD's defensive stance hurt during growth-driven markets. Problem number 3, you're falling for the high-yield trap. JEPI's 8.37% yield looks amazing until you realize it's from covered calls that cap upside potential. VYM's 2.63% seems low until you see Broadcom's 640% 5-year gain as its top holding. SCHD's 3.97% looks perfect until you notice Pfizer dragging down performance. Solutions? JEPI strategy. Best for immediate income. Accept limited capital appreciation. VYM approach. Lower yield but higher growth potential through quality holdings. SCHD balance. Middle ground with dividend sustainability focus. Problem number 4, you're ignoring the reconstitution game changer. SCHD's March 2025 reconstitution changed everything. They added ConocoPhillips as the new top holding and dumped Pfizer and BlackRock. Energy exposure jumped above 20%, completely shifting the fund's risk profile. Solutions. New portfolio analysis. Understand what you actually own post-reconstitution. Energy concentration risk. 20% plus energy exposure in volatile commodity sector. Timing implications. Changes position fund for inflation, not current growth environment. Authority building. Here's the data that'll change how you think about dividend ETFs. 1. Year-to-date performance reality. JEPI leads with 2.90% versus SCHD's 1.34% versus VYM's steady performance. Yield spectrum, JEPI 8.32%, SCHD 3.82%, VYM approximately 2.8%. But higher yield doesn't mean better returns. Third is current prices, JEPI at $57.16, SCHD at $27.17, VYM at $136.28. All July 30th, 2025. Volatility truth, JEPI's 1.90% volatility versus SCHD's 3.76%. JEPI is actually less risky short term. Analyst consensus. SCHD has moderate buy with $30.11 average price target, 10.2% upside from $27.32. Expense ratio advantage. SCHD and VYM both at 0.06% versus JEPI's 0.35%. Still reasonable for active management. Sector allocation impact. VYM's tech financials focus versus SCHD's healthcare, energy versus JEPI's diversified approach. Drawdown protection. JEPI's minus 13.71% max drawdown versus SCHD's minus 33.37%. Proves defensive value. Here's what institutional research reveals. SCHD's underperformance isn't a flaw, it's by design. The fund prioritizes dividend sustainability over growth, which works brilliantly during market stress but lags during growth phases. Professional analysis shows VYM's broader diversification, 500-plus holdings, provides better market representation, while JEPI's covered call strategy offers unique downside protection that passive funds can't match. Solution presentation. The complete dividend ETF decision framework. Which fund for which investor? Strategy number 1, the SCHD value position. Quality plus opportunity focus. Best for investors wanting 3.82% yield with dividend growth potential at discounted valuation. Current entry, $27.17 with analyst targets of $30.11, 10.8% upside. Allocation, 15 to 25% of portfolio as defensive core holding. Risk profile, medium, quality companies, but sector concentration in energy, 19.38%. Key advantages. Proven 13-plus year track record with 12.43% average annual returns. Strict quality screens eliminate dividend traps. 0.06% expense ratio keeps more money in your pocket. Post-reconstitution positioning for potential energy inflation cycle. Strategy number 2, the VYM stability play. Broad market dividend approach. Best for investors wanting dividend exposure with maximum diversification. Current status, trading at $136.28 with consistent steady performance. Allocation, 20 to 30% as core equity holding with dividend tilt. Risk profile, lower broad diversification across 500-plus stocks reduces concentration risk. Key advantages. Broadcom, JP Morgan, and other quality growth leaders as top holdings. Better short-term performance, 1 to 3 years, than SCHD. Massive diversification reduces single stock risk. Exposure to dividend-paying tech and financial leaders. Strategy number 3, the JEPI Income Maximizer. Covered call strategy. Best for income-focused investors, especially near in retirement. Current performance, $57.16 with 8.32% yield and 2.90% year-to-date gains. Allocation, 10 to 20% for pure income generation with monthly distributions. Risk profile, lowest volatility, 1.90% but capped upside potential. Key advantages, monthly distributions versus quarterly for SCHD VYM. Only minus 13.71% max drawdown provides downside protection. Professional active management adapts to market conditions. 1.95% volatility makes it the safest option for income. The ultimate portfolio combinations. Conservative income portfolio. 40% JEPI, high current income. 30% SCHD, quality dividend growth. 20% bonds, 10% cash. Balanced growth plus income. 35% VYM, diversified dividend growth. 25% SCHD, quality focus. 25% growth ETFs. 15% international. Aggressive value play. 30% SCHD, quality value. 30% VYM, market representation. 20% individual dividend stocks. 20% sector rotation. Close with urgency. Here's my bold prediction for the next 18 months. The dividend ETF hierarchy is about to flip. SCHD's current underperformance has created a value opportunity that won't last long. Why I'm confident about this reversal? 1. Valuation advantage. SCHD trades at 17 times earnings versus S&P 500's 26x. It's 1/3 cheaper. Second, sector rotation setup. Energy and healthcare are due for outperformance after years of lagging. Quality premium return. During any market stress, investors will pay up for SCHD's dividend sustainability. Analyst support, $30.11, Average price target represents 10.2%, upside plus 3.97% yield. The window is closing on this opportunity. While everyone's chasing JEPI's high yield or VYM's recent performance, SCHD is quietly positioning itself as the comeback story of 2026. Your action plan for the next 30 days? If you want immediate income, start with JEPI for 10 to 15% allocation. If you want broad exposure, VYM should be your 20 to 25% core holding. If you want value opportunity, SCHD at $27.32 is a generational entry point. If you want all three, use the balanced portfolio approach above. Track the rotation, watch for energy healthcare sector improvements favoring SCHD. The bottom line, there's no single winner in the SCHD versus VYM versus JEP debate. Each serves different investment objectives. But if you're looking for the best risk-adjusted opportunity right now, SCHD's temporary underperformance has created exactly the kind of value opportunity that builds long-term wealth. Your future self will thank you for buying quality dividend stocks when they're out of favor, not when everyone else is already piling in. This isn't about picking the hottest dividend ETF. It's about understanding what you own and when to own it. This content is for educational purposes only and should not be considered personalized investment advice. Please consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Please like this video and subscribe. Here's to your investing success. Profitable investing.